Hey, what's going on, everybody? Welcome back to the JESS MARSHALL Podcast. Wow. Mark that swipe. Bring it. Is better than like your NutraSweets, right?
That's what I've heard. I don't really know why. But they say sucralose, which is in a lot of them. It's also in Prime.
Yeah.
It's inflammatory.
So when you get to 200 million subscribers, you just have to have your own nutrition. Like they're just going to run nutrition for you.
That's right.
So you just walk out, your breakfast is ready, your hydration is ready.
And then Reventure hydrating.
Then you do your own thing and you go, over several years of experimenting and research, I have now.
This gave me the best productivity.
Yeah. Hey, actually, Reventure Hydration, that's a hell of a brand.
Yeah. Hey, anything's possible once you get big enough, right?
Which is cool too, because it's like real estate.
100%, yeah.
Venture.
Redoing, recharging.
Did you just come up with that yourself?
Yeah.
I meant to
figured
ask
it out.
I did.
9 out of 10 people don't.
How's that
understand
possible?
The connection.
Oh,
real estate, RE, and then re-looking at real estate, reventuring.
I usually ask like the functional medicine guy I had on, Blake York. His is called Equalist. So that come like from like Get Your Equilibrium and then Catalyst, and he put those two together. That. I do too.
Wasn't sure if
his
that was
graphic is awesome.
Equity or equality thing.
Yeah, no, like Equilibrium and Catalyst. How did you come up with Reventure? Were you just throwing stuff around?
No, exactly what you said. I was trying to think of words or phrases that could be, related to real estate in the title, but not necessarily say real estate. So it's RE. Real estate acronym. And then I'm like, okay, what do I want to do? Data analysis, give a new perspective on people looking at real estate. So, Reventure.
I love it.
Into real estate and take a look at it from
Did you run all those names by anybody, or did you just kind of roll with it?
I think I probably asked my mom and some friends in Boston at the time. Yeah.
Well, you're very linear, right? The way you think is you are so data driven. So to see that creative side is very cool.
Yeah, well, it's interesting. It's like two sides to my brain.
It is
super data driven and linear, especially how I look at the housing market.
Right.
But the way I built my company and YouTube channel is very intuitive.
Yeah,
it was not planned at all. It just kind of happened spontaneously. So I think that's probably like a trick. I'm not a business expert, but there's probably a trick in business is that you got to have both of those sides, right? Yeah. You got to have like the linear data-driven side, but then you also need to act almost like out of your own instinct and intuition, right? Rather than saying to myself like, oh, well, I have this many subscribers. I want this many in 3 months. I've never really thought of it that way. I've just always kind of done what felt like I should do.
Sure.
And that's been what's driven me.
And with the intuition is the creative
that's
side.
More the spontaneous creative
which you have to have creativity to be coming up with new interesting content all the time,
right? So because
if all you were doing is going on your YouTube channel and just droning on about shit that no one cared about.
Home price growth in Austin is X. Inventory increases Y. That would be boring, right?
Permit quantities have increased over the last 30 days.
Which you and me, love that stuff, right? But you got to like package it.
Yeah.
For my viewers, you got to like package it in a way that's interesting, right?
Yes.
It's more character driven, right? The character of the home builder.
Yep.
Okay, so they're pulling more permits or they're pulling less permits and now contracts are being canceled. You could speak to it as in what's happening to the data.
Sure.
Or you could speak to it as in what's happening to the character of the home builder.
Yeah. And
it's more interesting, I think, to talk about it from that lens.
On the last podcast, we were talking, hey, Sohail, when you get a chance, will you throw the timer up there just since we are going to stay as on point as possible. Yeah. When we were talking, you talked a lot about, it was Open Door.
Open Door, yeah, the whole flipper.
So these national flipper wholesaler type companies, there's a bunch of them, right?
OfferPad, Orchard,
Offer. There's one just called Door. Instead of Open Door, it's just Door. Yeah.
There's one called Knock as well.
Obviously Redfin, and Redfin's just had a bunch of layoffs recently as well. Do any of those have Chinese financial backing?
It's a good question. I can't say for sure. My initial reaction is I don't think so, because these are companies are often publicly traded. So they raise their money off the stock market, off people buying their shares, as well as credit and debt facilities from banks. So maybe the connection there is the banks that fund the credit lines to some of these companies could have connection or exposure to what's going on in China right now, because China's so big. Their economy is 15 trillion GDP. It's over 20% of the world economy, and its financial sector is huge. So there's kind of like a contagion element that could potentially happen if China's economy falls, if its housing market falls, if its banking sector has an issue. That will likely affect America's economy, America's housing market, not necessarily in like a direct way in the sense that like, oh, Open Door got their money from China, but more in that maybe the people giving Open Door money had exposure to China. I think it would be more kind of in that way that it would have a effect.
That makes sense. So this is the way I understand the Chinese economy. And I'm just going to say it from just like what I've learned reading, consuming content, and then through my observations, especially being raised by an anti-communist father.
Okay, let's go.
The Chinese economy is always growing, burgeoning. They don't have ethics. They're stealing everybody's ideas everywhere, all of that. All that aside, there are people in China, private citizens, who prosper greatly. But these are people with the blessing of the government. So every industry, every different industry in the CCP, in communist China, is essentially an arm of the government. Yeah. If the government says, yes, we will support you, go run this, you can be very prosperous if you run that industry or say that huge company. But really, it's the government of China running that industry. You're just an arm of it. Am I understanding that correctly? Am I oversimplifying
No,
that?
I think what you're saying is correct, because China is obviously still a communist government, and it's a top-down economy. So that's the big difference between China and America and much of the West, is we are a bottom-up economy, and that one that's dynamic, and that the people and the small businesses really decide the direction of where the economy is going. In China, like you're saying, the leaders decide. They come up with 5-year plans, and then they have their own things. So like right now, Xi Jinping is super into zero COVID. Right. That's their thing. Like, we can't have any COVID is their mindset. So they continue to lock down their economy, 1 month here, 1 month here, because there's COVID outbreaks when the rest of the world has moved on, right, from COVID. But China's still in it because the small leadership that you're discussing at the top, they value that. So the rest of the country is at the whim of what that small section of leadership does. And ultimately, that's why I think, despite the concerns of China, taking over America, I don't think that's going to happen, because that type of top-down, authoritarian-run government and economy is not going to be prosperous in the long run. Eventually, it's going to fail. Eventually, it's going to break because it's not dynamic.
Are you basing that opinion of that it's not going to work long term on history when you say that? Or are you also basing it on other things that you're seeing?
Yeah. I mean, the best historical example would be the Soviet Union. I mean, right? Like 60s, 70s, they were, competing with America, right? But then it became very obvious the longer that went on that they weren't going to be able to compete with America, and they imploded on themselves. China is going to have the same issue into the future, especially because its demographics are terrible. I mean, so right now, or in the next couple of years, projections from the UN and other sources show that China's population will start declining. It's actually going to start going down. And the UN projections say in the next 50 years, it's going to go down by 30%. So think about what that means in terms of your economic size and growth. If your population starts to go down, by 10% in 20 years, 20% in 40 years, the size of your economy and your influence in the world is also going to go down.
Well, so will the size of your armies.
That's true. Exactly. The size of everything.
And what's causing this? Is this down to the, so when I was growing up, it was always, well, if you were a Chinese couple and you had anything other, well, now there's they, them, this, that.
Right.
But if you had anything other than a him, so if you had a her, you do away with that her because you got one him. Right, is that still happening? And is this part of the reason for this? That's a massive.
Yeah, you're talking about the one child policy and then the favoritism towards males.
Yeah.
Yeah, right. Mm-hmm. So China obviously had the one-child policy for a really long time. They've eased off that pressure in the last decade, but it's still something that's very baked into the societal mindset, right? So if you, like you're saying, for a couple decades, if the government drills into people that you can only have one child and the preference is for a male child, that's not going to just like go away, because over the last 5 to 10 years, the government is now encouraging more children to be born and more girls to be born. So China's birth rates are horrible. They're really, really bad. They're very, very low. And that's one thing that's causing its population decline to go along with an increase in deaths, because it has an aging population right now, which is a big problem because it has an aging population, as you can see on this graph right here. It's projected to go down, but that could be saved if migration was positive. Right. Theoretically, you could lose people organically, fewer births, more deaths. But if you had people moving to your country, your population could stay high. But China doesn't have people moving to their country. They have more people leaving China than moving in. And so it's that combination of outbound migration with declining birth rates that's going to mean that China is in big trouble, both economically and demographically, in the short term and the long term.
More leaving than arriving. And is that just due to the fact that there's so much government everywhere? No one wants to move there because it's just such a drag to live there. Obviously, a gross, overly simplified way to put it, but is that why?
I think so. So I had a friend that lived in Shanghai for a couple of years, and he actually really enjoyed it. Shanghai is an international city. He said, it's like, obviously it's a specific culture, but you can get on there, if, you speak English and, that's what you do. But the issue is that more broadly, China is very into its culture. Right. And I'm not saying that's a bad thing to be really into your culture, but that's not necessarily attractive to people moving to the country. So like in America, what makes America attractive for immigrants is that it's a melting pot, and people who aren't from here, it's pretty easy to move to America and to integrate and get along with people and to live life. That's much harder to do in China. Maybe you could do it in Shanghai, but if you go to Beijing, it's a lot more difficult. Everything from the language to the food is just very different, very strange for a lot of Westerners. So there's less people moving there. And then when you think about the China lockdowns over the last 6 months due to the pandemic, the friend of mine who left Shanghai, his replacement at his job was also from the West. He got stuck in his apartment for months at a time and couldn't get food. So if the country's going to do things like that, or there could be a risk of them doing things like that, why would you want to move there as a Westerner, right?
Yeah, so you would not of your own accord decide, oh, this sounds like a great idea, and off I go. You're going, what?
Yeah.
And I got to ask permission to do what?
Exactly.
And I have to have only one kid, what? And I can only have a boy, what? Or even if that's softened up, just like you said, this very, very stringent adherence to culture, tradition, and doesn't seem like much flexibility. So it's not they're not attracting the best and the brightest.
No, and if anything, they're sending their best and the brightest to America, right? Because they every year they send, I don't know the exact numbers, but I think it's tens of thousands, if not hundreds of thousands of students to American universities on education visas who study in America, and many of them stay in America. So they often, not only do they not get our best and brightest, they send their best and brightest to the U.S.
If what the UN is projecting that the Chinese population is going to start declining over the next couple of years, well, it already has, but then it's going to be down 30% by 2070. I mean, that's staggering.
Yeah, that's crazy, right? I mean, and I don't think people understand this. And, this loops into kind of what we're seeing right now in China with some of the social unrest, and their housing market is starting to decline, and there's issues in the banking sector. And that's all tied to the fact that the growth levels are decelerating and could start to go negative soon, right? When it is not good. I know some people make some valid points, like we have a lot of population on this earth. Some people say maybe it's overpopulated, but more broadly, it is not good to have a stagnating and declining population, because for the reasons you said, right? Like your military is going to be less, your economy is going to be less, your GDP is going to go down. And so, I think rather there's this perspective of China being this behemoth that's going to overtake America, and that is just not true at all.
There's a lot of clickbait, out on the web all the time, lots of fear, China this, China that, TikTok, the use and conditions terms on TikTok. Now they know all your data. They obviously have made huge moves in the wind and solar sectors, stealing IP from American companies. We've all heard those horrible, crazy stories, right. Corporate espionage, so on and so forth. But back to your area of expertise, are the Chinese over here? I know they're buying real estate, but are they specifically buying housing? Do you know?
Yeah, it's a good question. So the data on this is not perfect, but from what we know, the National Association of Realtors just came out with a report discussing foreign home buying in America from March 2021 to March 2022. And what they found was actually a decade low in the number of foreign home purchases in America. So this flies in the face of the narrative that this housing bubble was caused by foreign buyers, especially Chinese buyers. Those levels are much lower today than they were 5 years ago. So there's less foreign buyers. And if you want to pull this up, it would be National Association of Realtors Foreign Home Buying Report, if you Google that. And the foreign buying reached a peak in about 2016, 2017. And then it's gone down incrementally since then for, I think, two reasons. Number one is China implemented strict capital controls in their country. So it's very difficult for a wealthy person in China to take money out of China and then buy a house in America. Like, that is very difficult. China doesn't really allow that outbound flow of capital. There's some ways to get around it, but basically that's restricted the amount of Chinese investment abroad. And I believe that would also restrict the amount of investment in other real estate assets such as land and office buildings and retail. Now, there is certainly the potential that Chinese companies, bigger companies or maybe government-backed companies could be buying farmland. I think we saw a report that it was either in South Dakota or North Dakota that a Chinese-backed firm bought some farmland. And that could be happening. And it's certainly something to watch out for because, I think we know for the reasons you described, sometimes China's intentions might not be the best because they do have a history of stealing intellectual property. They pick favorites. They often sandbag U.S. companies when they try to expand into China. I think Uber was a company that had a lot of issues specifically expanding into China. So I think the way to look at this would be, there are some concerns and there's some issues, but we are not seeing a broader takeover of U.S. real estate by China or foreign investors in general. In fact, the trend is the exact opposite when it comes to single family homes over the last 5 years.
So a lot of this fear is not based on data. A lot of this peddling of, the Chinese are in here and they're just buying all this housing property up and what's going on.
It's not based on data at all.
Based on data.
So if you go to this report, you should be able to open. There should be a report that you can open. Here, scroll down. That you see up. There's a download button. Scroll up. Download. And then scroll down. There's a graph. Keep scrolling. Yeah, keep scrolling. All right. That's it. That's the graph. So this is the number of existing home purchases by foreign buyers from 2011 to 2012 data from the National Association of Realtors. And you can see what I referred to earlier, that peak in 2017 where they bought 285,000 homes in America. And then since then, it's just gone incrementally down every single year. Do you notice that? And in 2022, That was a decade low of foreign home purchases in America. And they break it out by non-resident and resident. You can see A and B. Both of them are going down. So that's the difference if someone lives in America and is foreign and buys a home, or if someone doesn't live in America and is foreign and buys a home. But really, this is capital controls in China that started around 2017. You can see the impact. But also, interestingly, a strong U.S. dollar. The U.S. dollar has been pretty strong the last 5 years compared to other currencies, especially in the last 3 to 6 months. It's really gained. And what a strong U.S. dollar does is it makes it much more expensive for a foreign buyer to buy in America. Because all of a sudden, if the U.S. dollar appreciates compared to the Chinese yuan, that means, say it appreciates by 20% compared to the yuan. I'm just throwing a number out there. That means that it's now 20% more expensive for a Chinese buyer to convert their yuan into dollars to purchase a home. So we have multiple factors pushing down foreign ownership, foreign investment in America's housing market, which means this housing bubble was a domestic bubble. This was caused not by foreign buyers. This was caused by local buyers in America, both big corporations buying up homes and small investors buying up homes. That's what caused home prices to go up so much, especially over the last year when we had a reduction in regular home buyer demand starting in the middle of 2021. Investors then surged to kind of take the place of the regular home buyer starting a year ago. And that's what really caused home prices to go up, especially in a market like we're in Dallas or in Atlanta or in Jacksonville. It's local domestic investors pushing home prices up in America, or at least that was the case over the last year. We're now seeing that flip now that interest rates are up and the housing crash has started.
So it's flipping in that now you've got actual end users buying more and investors buying less because there's less value or less perceived value there from the investor point of view?
I think we have both buying less. So the higher mortgage rates certainly ding the regular home buyer, right? Because, most regular home buyers, I think it's 85% use a mortgage to buy a house. So, the higher mortgage rates push them out of the market, but they really push also the investor out of the market because the investors need to raise capital. Like people say, oh, well, they just buy in cash. Well, the source of the cash is not cash, it's debt, and it's debt linked to mortgage rates and interest rates. So we're seeing the debt issuances of these big real estate investors like Progress Residential. They're having to pay way more to raise capital, which means they are now only able to buy fewer homes. And we're actually seeing some real estate investors start to liquidate their portfolios. Starwood Residential just put up for sale, I believe it was 20% of their single family residential portfolios. You could pull up this article. I think it's from Bloomberg. I want to say it was around $1 billion.
Starwood Residential?
Starwood Residential. I think they're one of the 5 to 10 biggest corporate landlords in America, Starwood Group, and they're selling a big piece of their portfolio. So, I think we're seeing now a shift. You can see it right there. Starwood looks to unload 3,000 homes for $1 billion, seeking to sell thousands of rental homes as the U.S. housing market starts to ease. So what people got to remember is that investor presence in the U.S. housing market is not permanent. Like it's not something that's going to permanently push prices up. Rather, it's something that increases volatility. So imagine like this, the bubble's going up, prices are getting up, investors then jump onto the train, and say, oh, well, let me get in on this action. So then investors jump in and then push the bubble up further. But then when inflation and higher interest rates kick in and the economy goes into recession, those investors are like, oh, sorry, I'm going to take my profits now and I'm going to stop buying. And then that leaves a massive hole in the housing market and then causes prices to go down further than they would otherwise. And
that massive hole in the market leaves inventory if a lot of speculative building has started.
100%. So that's a good segue to our next topic about home builders, right? Because especially in a market like Dallas, I think the percentage is around 30 to 35% of homes were purchased by an investor over the last year. A lot of those homes were crazy, right? One third of homes purchased by investors. So you think
that's bananas, man.
So you think about like, what's the actual demand for homes, right? Because those investors will craft narratives saying, well, this is such a good place to buy because all these other people are buying homes and moving here. But if you are 1/3 of the home purchases, then that kind of flies in the face of that narrative. And where the problem sets in is in markets that, like you alluded to, build a lot of homes. In America right now, we're in a massive building boom. There's nearly 1.7 million homes actively under construction. That's both single family and apartment. There's another 300,000 permitted, not yet started. So there's 2 million homes in the active construction pipeline in America. That is the highest level in nearly 50 years. So builders, it's a combination of two things, which I think you're going to address in a second. The second part, one part is builders kind of went nuts. Permits, housing starts. Let's take advantage of this housing bubble in the same way investors said, let's take advantage of this housing bubble. But then builders had some issues the last 18 months because they started all these homes and they couldn't finish all these homes. So now there's also a pileup. Part of that construction pileup and pipeline is homes that should have been finished maybe 6 months ago that haven't been finished yet because you would know better than me. Why aren't they able to finish the homes right now in markets like Dallas and Atlanta and Phoenix and Vegas?
Well, there's a huge, there is and has been a big time supply chain issue across all industries. And when we say supply chain, we don't just mean, hey, we can't get door handles. We mean we can't get like the raw metal and materials and components to put together lock set components to make a door handle. We can't get lumber. Everyone knew lumber went crazy, whether that was an artificial inflation and escalation in that, or it was a true increase in demand and decrease in supply. Maybe all the loggers got the flu. I don't know what happened.
So you're insinuating that like when lumber went up by 400% a year ago, that there was some speculation involved in that, or maybe they were holding supply back from the market?
So as much as we talk about the markets here being interfered with, especially the housing market, and you've talked about the Fed in the past, we went over the movie The Big Short, that interference there flies in the face of that narrative that we've got this broad open, capitalism based market, right? The government interferes. But by the same token, when there's an increase in demand and there is a dollar to be made, our open markets, whether they're as open as some people say they are, or maybe not, there are people who are there to capitalize on that. And that's 100% their right. If you want cheaper lumber, then go grow a forest, cut your own lumber, mill it, deliver it, build your own houses. That's not how it works, obviously. And a lot of these big forestry operations are owned by much larger investment groups. So everyone's out looking to make money. And we talk about inflation, the cost of fuel, all of that. Well, we pumped all this money into the economy. And now if you're out there and you're an opportunist and not a victim, you can be looking at inflation as an opportunity to grow. And most people who you and I talk with and who you and I are like-minded with are looking at the inflation, whether it's a recession or a depression, whatever it is, as an opportunity for growth.
For sure.
But back to the home building thing, these interruptions in the supply chain have caused massive issues with home builders. I have several who are part of large local and national building conglomerates, if you will. Yeah. They're having a hard time getting HVAC units in these finished houses that have been done for months, and they can't close because they can't heat them. Just so like
my viewers know, you're a contractor. You work in the home building industry in Dallas. So
yes.
You have hands-on experience. You see this every day. You interact with these home builders every day. And you're saying, I think you said specifically there's a development somewhere in Dallas where there's a lot of homes that are almost done, but they can't finish them.
Yes.
Because they're missing one piece.
Yeah, this is a recurring theme all over the Dallas-Fort Worth Metroplex. A friend of mine who builds out west in Tarrant County, 40 or 50 homes ready at the closing table with closing documents through underwriting, ready to roll, but they can't get HVAC engaged, which means around here when it's 105 for 100 straight days with no rain, you can't move into a house if you can't cool it. And
so is there missing? What are they missing from the HVAC specifically? Is it like one small piece, or is it like the whole system? How should people think about that?
Yeah, there's different missing components. There's a lot of it is chip based. So these HVAC units and systems run off of computers, to oversimplify it. But the same way when you drive by a Chevy lot, there's no Chevys to sell. Well, there's no chips for automobiles, there's no chips for HVAC units. And if you can't run the HVAC unit, it doesn't matter if it's all put together. If you can't run that thermostat, you can't run the system, you can't close on the house. And if you're a builder and you have money and money looks for yield, then you just keep building and you figure it's going to figure itself out.
Right.
But this is starting to really back up on some builders. And as you and I have discussed, this has extending ramifications. For example, a structure is not made to sit vacant for long periods of time.
Interesting.
A house is a living thing. It sits there. It needs maintenance. It needs to be lived in. It needs people walking around inside of it, using it. It can't just be built and sit there for years on end or even months on end, and then there not be issues down the line. So what's going to happen? People are going to buy their house, finally get into their house, think to themselves, this is a brand new construction. I'm good to go. They're going to get in that house. They're going to start finding problems.
Interesting. So I think maybe we'll talk about this more later, but you think potentially that if someone's out there looking to buy a home right now and trying to decide between buying a new home, new build, or an existing home, I know a lot of people are trying to make that decision. You're thinking maybe there's going to be some issues if you buy a new home. Maybe you should buy an existing home instead. Is that
I do think there are going to be issues with new builds. I think that the new issues with new builds are going to be really similar to the new issues with new vehicles. If you've been sitting around waiting to buy a Chevy Tahoe for a year and a half, and you think that in August of 2022, when those new Chevys start rolling off the line, that you're going to go pick your brand new perfect Chevy Tahoe up, put the key in the ignition, and be good to go for the next 200,000 miles, you got another thing coming, and the same thing's going to happen with houses. There are going to be defects. And as long as it took them to catch the supply chain up just to get new houses off the line and new vehicles off the line, think about if your AC goes down and you're in the house with your kids, and school starts in the middle of August in most municipalities in Texas. If your HVAC goes down, you might be without HVAC for a month and a half, for 2 months. There are people all over.
Hell.
Yes.
Sounds like hell. Texas has been very hot for those watching who aren't in Texas. Just a tad. It makes you think back to the Comanches who used to roam the Texas plains and the grasslands. How'd they do it?
I don't know, man. Cracking maggots for hydration and nutrition. The Comanches were crazy. If you haven't read Empire of the Summer Moon, you should read it. It's insane.
I'll add it to the list.
Yeah, Quanah Parker, the last great Comanche chief. It's nuts, man. And I don't think people really understand, and obviously we can sit here and talk about this all day long, but it's where the rubber meets the road. If you are a new home buyer, maybe you moved to Texas, you rented for a year while you're waiting for your new house to be built.
I know a lot of people like that.
Me too. Now your new house is finally ready, finally got the chip, finally got the HVAC up, or starting school. You just need to be your own best advocate. If you're a new home buyer, just like you would be if you are an existing old home buyer. If you go to buy a new house, what's one of the prerequisites that a mortgage company requires you have done before they will say, there's a few, but what's one of the important ones that ensures that the asset that you're buying actually works?
Warranty.
Yeah, inspection report.
Yeah.
Right? So you send a third-party inspector in there. He goes into the house. If it's a existing house, say it's 10 years old, and he picks that thing apart, man. He's telling you, we got a wiring issue. You might have lead-based paint. Your roof has hail damage on it, whatever. He's looking for anything and everything. And you pay him $300 to $500, and he gives you a 30 or 40 page report. And then you go back, if you're the buyer, to the seller, and you go, all of these things are wrong with your house. And then it really depends on whether it's a buyer's market or a seller's market. Maybe you get...
But so that I think most people understand that that's typical for existing home purchases,
right,
but they don't think about it as much potentially for buying a new build home, because people think, oh, this is a new home. Yep. I don't need to worry about anything because this is brand new. But you're saying that's not the correct perspective.
So the perspective that you should have is, number one, most builders, spec builders, track builders who are building most of our brand new neighborhoods and subdivisions, they provide a pretty boilerplate 1 year builder workmanship warranty. 1 year. That's what you get when you buy.
It's less than my car.
Yes.
It's less duration than my car. That's insane.
And when you're a buyer, you're excited. You've been waiting. You finally are getting the keys and you're closing. You've got to slow it down, and you got to be your own best advocate, and maybe go in and make sure every T is crossed and every I is dotted. Make sure that you're holding the builder's feet to the fire. And this isn't about like, I don't like the color of that trim, or that door handle is crooked, or that,
it's a major. It's for the major items.
It is, man. And it is, how do I know if after a year, whoever the manufacturer of my HVAC system is, or the manufacturer of that electrical panel, is even going to be able to get what I need if a repair is needed? Because then go back to that scenario I described. You do move in, your kids are in school, and your HVAC goes down, and it's hot here until Thanksgiving. What do? You're going to go sit in a hotel room for months on end, and who's paying that bill? So you're paying your mortgage and your hotel. So the long and the short of it, not to get way off into the weeds, is if you are buying a new house, I would treat that new house the exact same way you would treat an established older home. I'd get an inspector in there, someone you can trust, just to go through everything with a fine-tooth comb and make sure that they rubber stamp it. And that still doesn't guarantee that nothing bad will happen, but maybe it'll help you.
That's great advice for people out there. You don't want any nasty surprises when you go to buy your new home. And it sounds like people are maybe a little not as into checking their new home as they should be. So that's really great advice. But there's one interesting thread to this that I think is going to impact the housing market severely in the housing crash. If you're talking about, there's, builders in Dallas who have 50 homes ready to go, except for one item. That's a big backlog of homes just waiting to all hit the market at once, right? And if you multiply that across markets, because if that's happening in Dallas, that's also happening in Phoenix, that's also happening in Vegas, it's also happening in Riverside, California, that's also happening in Tampa. So what if across the US housing market, there's all these homes, tens of thousands, maybe hundreds of thousands, that are in the situation of they're done. They just need one thing or two things to be delivered. Does that mean that now as housing starts are going down and the supply chain is easing, and when they do finish, to me, this says that we could very quickly get a deluge of inventory, which might already be purchased. But I'm curious where those people are living now who are waiting for those homes. Because it suggests to me that there's going to be a big surge in vacancies in America in either luxury apartments, homes that are rented, or maybe homes people bought just for the time being before they moved into their new home. Because imagine that, all of these units then get delivered at once. We're going to create mass vacancies in the housing market somewhere. It might not be in the newly constructed home that was just delivered. It's going to be where those people moved from. And I think that's a risk factor for the US housing market and the rental market right now that people aren't understanding, because right now rents are really expensive. They're going up a lot over the last 12 months, going up way faster than people's wages, which is the key thing to look at. You always kind of know it's a bubble if the growth in the rent or the growth in home prices is growing faster than wages. And I think we've developed a rental bubble in America right now, which not a lot of people are talking about. People are talking about the housing bubble more broadly. Home prices are too high, but I also think rents are too high. And we could see a crash in the rental market by the end of the year in 2022.
Yeah, that's very interesting. And I was going to ask you, when you were rattling off all that data about all the new housing bill, all the new starts, the new permits being pulled, all of that, where are all those people who have commissioned those houses? Because builders learned a lot in 2008. They learned not to overspec. Even if the bank says, here's the money, go build, lots of builders got left holding the bag with all these houses that were just ended up sitting there in 07, 08 when that last crash happened. What's going to happen then first of all, where are all these people coming from who are moving into all these new apartments and moving into all these new houses?
It's a great question. So we know over the last year, a lot of them were investors. There was a big surge in investors buying newly built homes. That's now going down. More broadly, a lot of the people buying new homes are first-time home buyers. D.R. Horton just came out with their earnings, and I think it's around 50% are first-time home buyers for D.R. Horton. I want to say for some other builders like Polt Group, it's around 40%. So it actually is a lot of first-time home buyers. It might be people locally. Like everyone kind of thinks that, it's someone moving from California buying the new home. But I actually think in most cases, it's someone locally, maybe trying to get an FHA loan, a low down payment FHA loan. Maybe their credit score isn't great. It's a lot of those type of people buying a new build, especially in these southern markets. And so, a good question to ask is like what you just asked. When they buy the home, when they move in, where are they now? And I think predominantly a lot of them are in expensive rental properties, expensive apartments is where I think they are now, or maybe renting a house for the time being.
Yeah, and you just moved. And I think, from a place that from place that you didn't really vibe with to a place you vibe with more.
That's right.
The rental market's been crazy, just like the retail market has, right? Like if you did want to rent, you kind of had to get in there, make an offer, get accepted, have your ducks in a row.
That's right.
Because it was for sure a seller's market when it came to these landlords, if you will, have all this empty space. They're the seller. I'm the buyer. I'm the renter. So what's going to happen when the rental market crashes out is all of these investors are going to have mass vacancies. Are they going to have a problem making the note, paying the mortgage because they're not going to have rent coming in?
You just hit the nail on the head. So I think this crisis, this housing crash and crisis, is going to be more about evictions than it's going to be about foreclosures. Because now we have investors owning about 20 million single family homes in America. So when investors now own so many homes, which is way more than they owned in 06, 07, that means that the performance of the rental market is now inextricably tied to home prices and the performance of the for sale housing market. So I predict, just like you said, by the end of this year, we're going to start to see this rental market crash play out. And when it happens, when investors are saying to themselves, not only are home prices going down, now my tenant's not paying the rent. Now I have a big increase in vacancies. That's going to be a huge incentive for investors to sell their properties. Because right now, I think some investors are still holding on because they say to themselves, okay, values are going to go down maybe 10%, 20%, but I'm still getting cash flow, or I still could get cash flow. Well, when you have a massive eviction wave come about by the end of the year, which I'm also predicting, then your cash flow now isn't there. And then that's when you have an issue. Maybe you can't pay your mortgage. Maybe if you're a big Wall Street investor, you start to have difficulties paying your credit facilities, which, by the way, every time the Fed hikes interest rates, that increases the cost of debt for credit facilities for big corporate landlords. So it's really all these things combining at once. And I think, just to zoom out and make it simple for people, I would think of it like this. We should have had a housing crash and a rental crash during the pandemic. We had a huge surge in defaults on mortgages. We had a huge surge in people not paying their rent. We didn't have a crash because the government stepped in, banned foreclosures, banned evictions, mortgage rates were 2.7%, and they pumped $50 billion in direct renter assistance to landlords. So, when the government does all that, you can skirt, the crash. But it's going to be very difficult for them to do all of that again. So we just kind of kick the can on all of these things.
It's not sustainable.
Down the road. It's not sustainable.
Yeah.
It's not sustainable.
It's not sustainable. Whenever there is a problem, the challenge is to see the opportunity in that problem. So maybe here's an idea. If you are a renter and you see, hey, my lease is coming up, maybe I lost my job in tech, which we're going to talk about in a minute. Is there an opportunity presenting itself there if you like where you live, maybe you like your landlord, to go work out a deal with your landlord and say, look, I lost my job, or I was demoted, or I'm having to hustle on the side just to make my rent. Can we work out a deal here that maybe a landlord would listen to this year in like the summer, fall of 2022, that last year, summer, fall of 2021, the landlord would have been like, bro, I got a line out the door to rent that house. I'm not giving you a $200 a month discount.
Yeah.
Do you think there's going to be an opportunity for that?
I love the way you position that as an opportunity. I think, yes, we're still early in this opportunity phase, but the market is definitely shifting on the rental side. And I think, the broader mindset people should have is finding ways to save money, right? That is a way to save money. Is to potentially negotiate your rent.
Cut those apps down, bro.
Cut those apps down. Maybe
Netflix.
Delete one of your 5 streaming apps. I did delete Netflix. Still haven't gotten it back yet.
Come on, man. Peaky Blinders, bro.
I know. I'm going to watch Peaky Blinders eventually. Maybe I'll borrow yours, although apparently they say they're cracking down on that.
They are. Yes.
But I think more broadly, the message is save as much money as possible right now. And I know that's like a simple message. And maybe it's one that can be difficult to do in an inflationary environment, but there's going to be opportunities into the future. There's going to be buying opportunities in real estate. There's going to be buying opportunities in stocks. I think there's also going to be buying opportunities in crypto. And you're going to want to be well capitalized with cash to do that. Because as things go down further, one thing that I predict is going to happen is the debt market, the lending market is going to tank. And banks are not going to want to make mortgages. Stock traders, brokerage houses are not going to want to give margin for stock trading and for crypto. So you're going to want to have cash, and you're going to need to have cash to take advantage of these opportunities that are coming in terms of buying a cheaper home, in terms of buying stocks on the cheap. So that's the one thing to think about right now, setting yourself up for success. And one of the ways you could do that is try to lower your rental costs, try to budget, try to save money in the areas that are discretionary and tighten the belt for the next year, because you're going to be rewarded for that when things come out on the other side.
And if you're a property investor, a real estate investor, I had Roughneck to Real Estate on, Corey, a couple of weeks ago, and he was talking about, well, if we do have this housing crash and the banks have to take all these houses back, then we'll go buy our next round of investment properties from the banks, and they'll lend us the money to do that because they're not property managers. They want that shit off the balance sheet. I think when there is inflation or there is some sort of disturbance in the status quo, everyone gets uncomfortable and they don't like to be uncomfortable. Right? Everybody wants to be comfortable. But the challenge would be to see those problems as opportunities as much as possible. And if you can't see the opportunity in a problem, go find someone who does see the opportunity in a problem and listen to them and pick their brain and figure out, well, why aren't you worried? Why do you think this is going to end up okay? Because the temptation is to sit around on the internet and let your thumbs freak you out.
Doom scroll.
Yes. And there seem to be a lot of people who are gearing up and excited about the prospects of what the future brings. And those are the types of people I know you and I like to talk to sit down and talk with, because getting out there and being a mover and a shaker and getting things done is a hell of a lot better than just sitting back in this, being paralyzed by fear, wondering,
100%.
what's going to happen? What do you see with private money investors when it comes to housing? Do you have much experience, or have you collected much data or been able to observe the way they act and react when it comes to, whether they're hard money or kind of your medium money lender? They're looking at housing starts. They're looking at rental vacancies. They're maybe you, Nick Gerli, go to them and go, hey, I found this duplex and I want to buy it, fix it up, live on one side, rent the other side out. Would you go to a bank for that, or would you go to a private money guy and negotiate a deal?
Yeah, I mean, that's a great question. So, banks right now it's going to be difficult, right? Because they're going to scrutinize every aspect of your business plan. You might be able to do that. The issue with hard money lenders, on the other hand, and I used to work for a lender that, I don't know if it's hard money, it was higher yield bridge debt. And, those lenders in times of crisis tend to seize up a little bit. So, that's one thing we're seeing right now. The hard money spigot for home flipping has been shut off over the last 3 to 6 months. And I think if you do want a hard money loan right now, you're going to be paying like double digit interest rates on that loan, which could be that's very risky to do at this point in time. But I don't want to steer people away from that. I want to say there's going to be a point in time when values go down enough and you're getting a good enough deal where you can then take that risk. You could say, okay, this hard money loan is 13%. Like, this is crazy. I got to hold my nose to take it, but I'm getting this property at a 30% discount to what it sold for 2 years ago. That's when it makes sense, right? And so I think it's important for people to have a data-driven mindset on this, because, it's a blurry line between, the optimistic opportunity taking mindset, and then there's this like FOMO mindset. Right? We don't want to be the FOMO mindset of people who kind of use the narratives of opportunity to just justify doing whatever and following the trends. Like, there's some people right now who are saying to themselves, you should buy stocks now, you should buy real estate, because they know in their head, they're saying they know that Jerome Powell is going to pivot and the Fed's going to save the economy. And that's their entire thesis for buying still at record high valuations. Like, that's not smart. That's not good. That's FOMO. Rather, you say, okay, what are the home prices today? What are the home values? How do they compare to incomes and rents? What am I projecting for the next year in terms of this downturn? What's the price where I'm in?
Yeah, that's a good point. Also, Sohail, you just put this up. Millions of Americans have used risky financing arrangements to buy homes. I wanted to ask you about this. What about these people? Let's just talk Dallas-Fort Worth. Okay. The last 12 months here in the housing market have been nuts, right?
Right.
People are going in, no option, no inspection. They're buying cash. They're paying $100 over ask. And it's just this free for all, complete seller's market. What then happens when maybe the bubble in DFW isn't going to burst? And we'll talk in a minute about how our diversity of industry here is a little different than, say, Austin or Boise or Salt Lake. But if you bought a house way over appraised value because you were buying it with a trust fund, or maybe with all your equity from your home in a way inflated market like, say, Southern California, you come here and the market does take a downturn. You've bought that property at such a high marker. Are you in danger of really paying a penalty in terms of your financial future for a long, long time as you try to get back up past what you bought it for if we do dip a little bit?
100%. And, the answer to that question really depends on the type of buyer, right? Like, if you're someone who is from California, you sold your home in Orange County for 1.5 and you bought your home in Dallas for 1 million and you overpaid by 200,000, you might not care. Like, honestly, home values are going to go down. You overpaid by 200,000 and it's going to take 5 years for you to get that value back. But you're so financially set that it's no big deal. The problem comes in when someone's taking out an FHA loan, which those are typically at 95% leverage, only putting a 5% down payment. Often these are first-time home buyers with lower credit scores. Them buying and overpaying at the top of the market is a problem, because if home values go down by 10%, they're underwater. right? Because they only put down 5% on their loan. The other issue is the investors as well, because, okay, yeah, the investor buys in cash at the transaction, but that's always funded by leverage in the background and by debt in the background. So if home values go down by 15%, a lot of these investors are going to be underwater. Like Progress Residential, one of the biggest home buyers, corporate home buyers in America, in 2021, they were raising about 90 to 95% leverage from debt to buy their single family home portfolio, which is insane. Like that a corporate buyer is getting that much leverage. So there is a lot of risk for people who use high leverage and debt to purchase their homes. They're going to be underwater for not just a year. They're going to be underwater for 5 years. People who overpaid in cash, they have the financial flexibility that it's not a huge deal. But more broadly, the way to think about Dallas and other housing markets is it's about the incremental buyer. It's not so much like, oh, is that person who bought in California going to sell? It's, does that buyer from California now exist into the future? That's the question to ask, right?
So you're asking a sustainability question.
Sustainability. You nailed it.
Is this repeatable?
Is this repeatable? And the answer, in my opinion, is no. As we talked before in our last podcast about the California migration trends, we're already seeing a slowdown in wealthy home buyers coming in from LA and San Francisco into markets in Texas and Idaho. So that means we're not going to have as many of those cash California buyers going forward, which is going to create problems. That's going to cause prices to go down on their own. And then really, where I think you're right. You alluded to the fact that Dallas has a more diversified economy, right? Like when you look at all the big corporations that are here, you don't even know. Like, oh, it's like, that Rolex, their North American headquarters is in Dallas. I had no idea. I just walk by the building. There's all these companies here.
Isn't Goldman Sachs moving to downtown Dallas?
Yeah,
soon?
I believe they're doing wealth management potentially in downtown Dallas. They're bringing a lot of jobs. So
like a couple thousand high-end
jobs.
Yeah.
So that's a finance exposure, which is probably going to perform a little bit better in an inflationary environment. Dallas has real estate exposure. They have tech exposure. So Dallas is going to get hit, but it's not going to get hit as hard as a place like San Francisco or Austin, where it's like a crazy amount of exposure to just tech. I would imagine, I lived in Austin for a year. To me, it seemed like at least half of the home buyers in Austin worked in tech. And San Francisco is probably like 3/4. So if you have a secular downturn in tech, we're seeing right now, Facebook Meta just said that they're going to be laying off staff for the rest of the year, lowered their revenue guidance. If you have startups going out of business, going bankrupt, announcing layoffs, that's going to mean the main source of housing demand in these cities is gone. It's completely gone. So in that sense, I think Dallas will perform better. But we're going to see a broader housing market downturn in America.
Your projection, the top 10 housing market bubbles to burst, where Austin was number one.
That's right.
What have you seen in the last couple of months to support that? Or have you seen that's kind of surprised you? That's like, oh, wow, I think you had North Carolina market in there. That Raleigh-Durham area. Don't they call that the tech triangle? That's right. I believe. My parents lived there in Cary for a while. Right?
Oh, really? Yeah, it's a great suburb. Yeah.
Are you seeing, that was a fascinating video you did. Are you seeing that everything's playing out the way you thought it would, or have some other possible components come to play that you didn't expect, something unexpected?
I would say mostly it's playing out almost exactly like I thought it would. The metros with the biggest surge in inventory right now are Austin, Boise, Salt Lake, Phoenix, Las Vegas. Those are the metros with the biggest surges in inventory.
Surge in inventory. You're saying builders building new houses?
I'm saying everything. I'm saying existing homes are piling up. New homes are piling up. Price cuts are piling up. Prices are starting to go down in those markets. So I think more broadly, it's happening as I expected. Interestingly, we're seeing that the Midwest...
Nostradamus Gerli.
That's right.
Over here.
Yeah, that's right. I mean, so far, the predictions have been pretty good. And I think they're going to continue to be good because, the other interesting aspect we're seeing is actually the Midwest and the Northeast is not in a housing crash right now. It's very interesting. Holding steady. Home sales in the Midwest and Northeast are down a bit, but they're holding steady. The price cuts are very low in a metro like Chicago. In a place like New York, very low share of price cuts. So there's something about the steadiness and the affordability of some of those areas in the Midwest and Northeast that's keeping their housing markets from entering a crash. Whereas in the Sun Belt and tech-related housing markets, we are in it right now. And we're in the beginning stages. So very important that people remember this, that we're in the beginning stages of this housing crash. It's going to take time. I see some people out there getting frustrated. They see, oh, well, inventory's doubled year over year in Austin, but prices are still above where they were 2 years ago. And that's to be expected. The housing market, as I say, it's kind of a slow motion crash. You start with more inventory, you start with more price cuts, but sellers are emotionally attached to their homes. They're not going to cut as much as you want them to at first, but it takes time. From 2007 to 2009, it took about 2 years for that last housing crash to really get going. It took 24 months for prices to go down about 20% across America. And then it was another 2 years of them incrementally going down more. So it's important that people also have the right perspective. It's not as if you're going to buy an amazing deal in 3 months, but in the next year, you're going to start to see some really good deals. So very important that you watch out for that. You pay attention to what the inventory rates are in the market and the price cut rates. And, you just look for what my reservation price is, what's my strike price, and then find a deal that meets it, if it's in 6 months or if it's in 18 months.
When we tell people go be your best advocate, go do your own homework, educate yourself, those are really easy things to say to people when you and me know where to go to find data. Mm-hmm. But this is why you started Reventure, right? To collect the data, to help people, to point them in the right direction, and to try to kind of shine a light on patterns that you started to discover instead of these colloquialisms or the FOMO or I have knowledge of that territory, that area. I'm good if I'm a home flipper. I know what that neighborhood will bring in terms of a yield. People want to educate themselves on, hey, what's going to happen in terms of markets? Where are these bubbles really going to burst? And if I'm in Dallas and I'm investing, or I am, looking to be a new or existing home buyer, am I safe? What type of content do you have coming up on Reventure that people can look forward to you dropping that's going to be educational and add value like your stuff always does, but where they can go, wow, they can dial in a video or two of yours and really get some distilled, 100 proof Everclear, like the real goods, top shelf moonshine good stuff that they can be confident about moving forward as investors or first time home buyers, or maybe they have a family in a home and they want to buy a rental, to start to create like a portfolio so they can put their kids through college in 15 years. What type of content do you have ready to drop or coming up or kind of working up there on Reventure?
Yeah, well, I got some really exciting content coming on foreclosures and mortgage defaults, and specifically the cities where I'm predicting there's going to be the most foreclosures. And not only that, the neighborhoods that are going to be the most foreclosures, because you need to start building. If you're someone who wants to get a deal, buy a foreclosure, buy from a bank at a discount, you need to start learning the cities and the neighborhoods where that's going to be available now, so you're prepared over the next 12 months to strike while the iron's hot. So that's going to be a video I have coming out in the next week on foreclosures. Some really fascinating data. Basically, I aggregated all of the loan purchase data and mortgage purchase data in America over the last year to find the cities that have the highest percentage of risky mortgages, highest percentage of FHA loans, second home buyer loans, and investor loans that are high leverage. Those are the ones we're going to be seeing the biggest defaults and foreclosures going forward. So you want to target those locations specifically.
The risky mortgages are going to have a lot to do with obviously the people who applied for and got the mortgages and what they do for a living. Because you've mentioned numerous times in the last pod and then today how if we start seeing housing or rental pricing go up, but we're seeing income levels stay the same or decrease, we know there's a problem on the horizon, right?
That's right. That's exactly right. Yeah. And you're right. It does have to do with, it's really the type of loan, and it's the financial ability to pay the mortgage, and then whether the home is primary occupancy. So FHA loans, I've mentioned them a couple of times, they have the highest default rate by far because they're 95% leverage and the borrowers have lower credit scores. So naturally, they're going to have more defaults. But what's interesting is the mortgages used for second homes, which are actually kind of risky when you think about it, because you might say, oh, someone's buying a second home. Well, they're not going to.
Yeah, they're loaded. They're fine.
Which the fact that they used a mortgage to buy the second home shows they're not loaded. Right. And so, they have the expenses of a second mortgage payment, property taxes, insurance, and it's a discretionary vehicle. It's a discretionary asset for them. So we're going to see those often have high rates of defaults, as well as investor loans have much higher rates of default. So I combine all three of those metrics to show you guys the cities that are going to have the most foreclosures. If you're a real estate investor, you're definitely going to want to check out that content.
We've thrown around the Fed a few times, and then the term FHA loan. For people watching or listening who are unfamiliar with what is an FHA loan, can you break it down in very simple, easy to understand terms what exactly an FHA loan is, why it's somewhat problematic, and why it's so popular?
Sure. It's a government-sponsored loan. So it's actually not specifically the Fed, but it's the U.S. Treasury and U.S. government.
Federal Housing Authority, FHA.
The HUD. It's HUD, Housing Urban Development, that backs it. And they basically it's a quasi-government loan facility where the banks are making loans they would not normally make. Like that's the point here. Banks would not normally make the loans under the FHA program unless the government gave an implicit backing for those loans. So that's kind of what's going on. And it's a loan product tiered to first-time home buyers who don't have much money for a down payment, who have lower credit scores. So it's good in one way. It gives opportunity for people who maybe are on the lower end of the income spectrum to participate in the housing market. But inevitably, we know what that's going to mean, especially people buying at the peak of a bubble entering a recession. It's going to mean lots of layoffs, and foreclosures in this loan segment.
So these are not the people who are qualifying for an FHA. And again, if you have an FHA loan, we're not indicting you for being a bad person or a loser or any of that. Just explaining what it is. But these are not solid investments that the bank would have made on their own to make money, which, by the way, is why banks exist. They take your dollar and then they lend it out 9 or 10 times, right? That's why
it's a government subsidized loan program. So
you're almost an irresponsible bank if you don't take advantage of the fact that the government's like, look, write that loan, we'll back the loan. If there's a problem, Uncle Sam will bail you out. I mean, if you're a bank, why wouldn't you take that deal?
Yeah, 100%. And the U.S. mortgage market is a heavily regulated market where the government is heavily involved. And there's pros and there's cons to that situation. And so the pro is if you're a real estate investor, there's going to be opportunities for you based off that.
You mentioned that you will see or listen to people all the time making investment advice, buy stocks now. The Fed is going to do this. The Fed is going to do that. You had a video about 40 to 60 days ago, possibly sooner, maybe more like 30 to 35 days ago, about something that the Fed chairman did, about a move he pulled. And then there's all these people talking about hypothesizing what the next move is going to be. Do you see that they're just going to stand pat and let things smooth themselves out and let economies of scale and capitalism go to work? Or what do you see there?
Yeah, well, I think the thing to think about, and the big question on people's minds is, are we going to continue to see the Fed hike interest rates? Because if the Fed continues hiking interest rates, that's going to naturally push asset prices down. It's going to encourage people to save more money because, oh, by the way, you can now get over 2% in your savings account, which people forgot. Maybe you can get money in a savings account if interest rates go up. People are now saying, oh, well, maybe the Fed's going to cut rates and pivot, which is going to save the economy and push asset prices up. And, a lot of people, the concern I see is a lot of people are just leveraging their investment strategy purely based off that. They're speculating that the Fed is going to come in and save the day by cutting rates, which would theoretically prevent a recession. I don't think it will. Potentially could push asset prices up. My concern with that is right now, and why I don't think the Fed's going to pivot as quickly as people think, is right now the inflation rate's 9% year over year. The unemployment rate's 3.6%. So inflation's up here, unemployment rate's down here, meaning that the Fed has met their policy goal of maximum employment. Like we've almost never had a lower unemployment rate than today. Meanwhile, they're utterly failing on their goal of price stability. So as long as inflation is way higher than the unemployment rate, the Fed is going to hike interest rates.
Isn't that unemployment rate, though, a bit... It's deceiving because the numbers being used to achieve that 3.9% figure that you just stated cut they only take into account those that are in the current job market.
Yeah, so there's different unemployment rate statistics. There's 6 different ones actually that the BLS reports on. The commonly reported one, it's true. You're saying basically they don't include people who are discouraged workers who stop looking for work. So that is true, but by all measures of unemployment rate, we are at a historic low or close to a historic low right now. So what that means, the Fed is going to hike. And I think what you want to look for, if you're trying to predict kind of when the shift is going to occur, because eventually the Fed will pivot and cut rates, it's going to be look for the inflation rate to go down and the unemployment rate to go up. And I think when they cross, when the unemployment rate goes above the inflation rate, that's going to be all of a sudden when the Fed says, okay, we gotta ease off.
Is that crossing when those two cross? Is that something that's predictable, or is that as unpredictable as ever because of all of these external forces happening, like this war overseas and things of that nature?
What's crazy right now is that we've actually, in the last 40 years, never been in a situation where inflation's been so much higher than the unemployment rate. Normally, it's the opposite. Normally, the unemployment rate is higher than inflation. So not only are we in the opposite situation, we're so much in the opposite direction in a record fashion, which means that the Fed has one mission in this situation, and that's to push inflation down. So, that's based on historical data, right? And I guess that would say, to your point, we are in rare times right now. But I think it's important to look at this historical data, right? Because when you look at it on a graph and you see inflation up here and the unemployment rate down here, and historically it's never been that way, it becomes very obvious what the Fed's going to do.
What we're happening right now is absolutely an anomaly.
Yeah, for sure.
The inflation where it's at with this, whether you believe those unemployment numbers or not, but with this unemployment rate, so they're getting a gold star down with these
a gold star on maximum,
and they're getting a F plus on this inflation. If the Fed cuts interest rates to save the day, doesn't that just kick the can down the road even further?
Could be. So there was a period in the early 80s where we had a double dip recession, where in 1980, 1981, we had a 6-month recession, and the Fed cut rates. And then inflation came back like 5 or 6 months later. And then we had an even worse recession after that, and the Fed had to hike rates even more. So that is a potential outcome, that at some point the Fed is going to pivot and cut rates. And then for 6 months, it's going to look like inflation's low and the economy's great. And then all of a sudden the inflation comes back. And then the Fed has to get even more aggressive in hiking rates. That's something that did happen in the early 80s. And that's definitely a kicking the can down the road outcome, like you said.
Yeah. And possible. I mean, it's the uncomfortable nature of this really high inflation. Now, fuel prices have come down. I believe POTUS just took credit for that, said he was saving everybody $25 a week. It's very confusing because like 3 months ago, POTUS said he had no control over that. So we have no control when it gets bad. When it gets a little better, I get all the credit.
It's very clear why gas prices are down. If you look at data from the Energy Administration in America, it's because gasoline demand has gone down. People are driving less. So that's why gas prices have gone down. It's not anything to do with supply. It's a demand issue.
So gas got more expensive, gas and diesel. And people said, okay, I'm going to carpool, or we're not going to the movie theater to watch Top Gun Maverick. We're waiting for a month and then we're going to stream it.
That's right. We're going to work from home.
Yeah. And again, all you have to do is look at data, right? Do you have content about this inflation stuff coming up?
Yeah, for sure. So I have a video coming out tomorrow that's going to be more broad about like the stagflation, because we're seeing stagflation now.
What do you mean by that?
Recession. We have a recession, even though certain people don't want to admit it. Mixed with inflation that's at record highs. Normally, when you're in a recession, inflation should be much lower than it is today. And we are seeing it start to go down, but it's still way too high. So that's stagflation and the situation we're in right now. And I'm going to include some predictions for where I think that inflation is going to go. I'm going to talk about gas prices, going to talk about the recession, and what I think the Fed's going to do in response.
When viewers and listeners want to reach out to you, well, first of all, on Reventure, which, by the way, love the name Reventure, and we didn't get to talk about that on the last pod. How'd you come up with the name Reventure Consulting?
Yeah, it was 2 or 3 years ago. 3 years ago at this point, I was in Boston, and I quit my job, and I was going to start this company, and I didn't know what it really would be or what the name was going to be. I knew I wanted to be real estate related, and I was like, okay, RE, real estate, RE. And then what would signify real estate but looking at it from a new lens, which is what I wanted to do, provide data so people could really understand real estate in a better way. I said, reventure. Let's reventure into real estate and look at it with a new data-driven lens. And that's how I came up with the name.
That's awesome, man. Very creative. Like we talked about, we got to learn not to talk unless the cameras are rolling, like true reality TV personalities, because we talk about awesome red shit and it's not. Your Reventure YouTube channel is just value laden, as I've mentioned many times. People can go there and get value for free. But if they want to get even deeper value and they want direct access to you to ask you questions, can you explain your membership program?
That's right. So my channel now has over 250,000 subscribers, but there's also a join button where you can join as a channel member and you get access to even more data on the real estate market, the economy, and the housing market. I post interactive graphs and maps for my channel members. So, a lot of the graphs you'll see in my videos, they're going to be available to you to look at as a channel member. The cost is $5 a month. My current channel members love it. I have around 3,000 now. So it's like you're saying, it's a very value forward proposition. So hit that join button and also make sure to become a subscriber if you haven't already.
And then when they are a paying member, they've got a more direct access to communicate directly with you.
That's correct. So there's a members only community board where I'll post maybe 4 or 5 times a week.
Club Reventure, bro.
Club Reventure, VIP. Yeah. Let's call it a VIP section.
Bottle service only.
That's right. So we have a VIP section and I respond to pretty much every comment from my channel members in that VIP section. So that is a way to get more direct access.
Awesome. And if people want to hit you on Instagram, should they hit you up on your personal or on your Reventure?
On my
Instagram
Reventure,
picture?
it's at Reventure_consulting. And I'm also on Twitter. It's at Nick Gerli1 on Twitter.
Awesome. And we're going to collaborate a bunch more over the next coming months. And I'm also reachable anytime on my Instagram and TikTok at Jess from the Northwest, or you can email me anytime live at autographconstruction.com. If you are buying a house, if it's new or if it's used and you have questions, I'm here to help anytime. Don't be a victim. Builders are good people too. They make mistakes, but a lot of them, the things that are going to happen in the next several months, we don't even know what they are. We don't know if garage door openers are going to be defective, HVAC furnaces when they turn on for the first time in 3 or 4 months when it gets cold. What's going to happen then? No one's even thinking about that. You move into a new house, your irrigation goes down. Very difficult to get the control panels for sprinkler systems right now as well. They're using different materials in the glue that they glue PVC pipe together with in the ground.
So they're basically, it's like a hodgepodge. They're just trying to put it together to get the home done. And you're thinking that, okay, they're trying to put it together. Great. You're going to move in, but there's going to be issues.
They're using stopgap measures everywhere. And you cannot make chicken salad out of chicken shit in construction. I use this example all the time. My dog. Want to prolong the longevity of my dog. So I just decided, well, if I'm going to concentrate on putting the best nutrition in me, why don't I concentrate on that for my dog? So I found this food for my dog and it made all the difference. I'm not feeding my dog pellets anymore or the pemmican.
Organic, all natural.
Yes, comes frozen. I mean, it spoils if the dog doesn't eat it within a couple hours. I mean, this stuff's really good. Then I started noticing an issue. And the dog starts going back to having the same struggles. You give a dog dry dog food, there's sawdust in there. I mean, if it says China anywhere on the label on dog food, you better run. Same with supplements if you're into fitness. Start doing this research, start wondering, start reading on Reddit. Well, the ingredients that the dog food maker is getting from their source, their vendor source, whoever's sending them carrots or cornmeal or whatever it is, that's been compromised. So like I said, I used the example of hardware on a door down to the last spring, which is made out of some sort of metal or alloy. We have compromises in the supply chain all the way from wherever it comes out of the ground or out of the sky, all the way to whatever it's made in, whether it's the water in our water bottles, the plastic that makes whatever it is.
So how do you
issues everywhere?
So I believe you. That makes a lot of sense, right? If everyone's trying to, like you said, put stopgap measures. So how does someone protect themselves? I guess you have to be, like you're saying, your own advocate. You have to do your diligence. You have to pay attention on all these things.
Yes, I think it's really important to build yourself a little network too of pros. So becoming a member of your very valued data-driven YouTube channel. Now, anytime I have a question about anything housing or real estate related or anything that needs data analysis, I know where to go. You reach out to me anytime you have any question about construction. You might live in Dallas, you might live in Detroit or Des Moines, it doesn't matter. I'll give you advice. I'll let you know, hey, this is how you should find a good subcontractor or general contractor who's going to shoot you straight. Yeah, I think, listen, when it comes right down to it, a lot of the people that we deal with in business are just good people who are working hard. And right now we're all making the best out of tough times here and there. And nobody who you and I deal with has quit anywhere in their vocabulary. So if you are a homeowner or if you are anyone in construction, anyone in real estate, and you're like, I'm really struggling to connect with good people. That's why people like you and I are here, is to help them.
That's right.
And my door's always open. You can always DM me or email me. I know the same is true for you, and I appreciate you again, man.
Great talking to you,
Fun as always.
Yeah, this is unbelievable.
Legit. Awesome.